Welcome to another stage analysis video. It's Sunday the 28th of May 2023. Got a fair bit to get through tonight. Apologies, it's a bit later than normal with the holiday weekend, but we have got an extra day with the market closed tomorrow still, so plenty of time for you to get through it. Just a quick note for anyone new to these videos, you don't have to, they run for about an hour to an hour and a half generally. Normally the weekend video goes to about an hour and a half, but it's divided up into multiple sections each, which are between 10 to 20 minutes or so each. So you can see, if you can use the chapters feature in the bottom bar in the video to obviously skip to relevant sections, whether it's the weight of evidence, the watch list area, obviously industry group relative strength rankings, etc. So you don't have to watch the video in any particular order. It's all obviously as part of the overall process from the stage analysis method. So we're looking for the weight of evidence from all of the different areas. So starting off with looking at the indexes, going into the individual groups, looking at the market breadth data before getting into individual stocks, etc. So lots to get through each time, but you don't have to watch it all together as one big long video, as I appreciate the hour and a half is a very long time for a video, but it does, obviously there is always a lot to get through, and it's a big part of the stage analysis method is process, and a lot of people obviously miss that. So we try to give you all of the data and try and present it in obviously a very balanced way, hopefully as neutrally as possible, without trying to impose my opinions on it too much, but just to give you obviously the most useful data. But let's get started now. So let's get into, we're going to start off with the major indexes this week. I've been starting over the previous few weeks with the stocks in stage, the bigger movers in stage 2 on volume. There's obviously a lot of those this week with the semiconductors breakout. So I'm going to leave that to a little bit later in the video, as some of those obviously have had some huge moves and there's not so many that are in good positions. So I thought it'd be better to start off with the major indexes this week. So starting with the S&P 500, as we normally do, obviously most significant of the indexes that we measure everything against in terms of relative strength. What they use, our Mansfield relative strength, goes against this with every single stock or other ETF and index. So currently we've had the last few weeks back testing the stage 2 level again, as you can see up here. Just it is coming into still underneath a longer term major zone of resistance. You can see this area through here, so which has been tested multiple times throughout the last few years, many obviously tests, which is still underneath, but we have been making higher highs, gradually grinding up since the October, I think it's October 13th low there. So now testing the stage 2 level at the moment. But you can see from the combined percentage of stocks above the 50-day, 150 and 200-day moving averages, which I do as a custom indicator for the members. We'll do as part of the weight moving average breadth each week. I've applied this to the S&P 500 chart here, but this covers the entire US market. So it's about 7,000 plus stocks. So you can see at the moment this has been very flat while the indexes have been moving up. As we know, the Nasdaq and the Nasdaq Composite have been moving significantly higher into early stage 2. But obviously the overall weight of evidence here from the combined percentage of stocks has been very flat at the same time as that's been happening. So it has been obviously a select area of stocks and groups that have been moving strongly: software, semiconductors, obviously some of the mega caps, etc., and the home builders, etc., but they have been starting to pull off a little bit. But there's only been a select area. It's been, see, the broader market has been very flat at the moment, still holding at 39% at the moment. It's 39.45, I think, at the moment, off the top of my head there. So obviously we would expect this to be stronger at the stage 2 breakout point. Typically at the stage 2 breakout point, it's above at least 50%. Generally at each stage 2 breakout in the past, it's been around the 60% plus level in the last 20 years or so. So at the moment, this still remains an anomaly at the moment. Look at the daily chart, you can see a good rebound move Thursday, Friday, back up testing the highs again. Percentage of stocks above their 20-day moving average rebounded out of the lower zone. So 34.6% at the moment, slightly stronger volume there, but still obviously hasn't cleared the near-term pivot high there, and still in this major resistance zone I just highlighted on the weekly chart there. We zoom it out a little bit low. Then add the combined percentage of stocks but above their 50, 150 and 200 day moving average back to the chart again on this monthly chart as we're coming to the end of May. We've still got another 3 days yet, so this could change still, but at the moment we've still got this, what's the rising wedge type pattern, which I haven't managed to push out of convincingly yet. Still a bit of a obviously dangerous looking pattern at the moment, as we could obviously, looks like a bear flag, could obviously break to the downside here to retest those October lows once more. But if it can continue to hold above this 30-month moving average, continue to grind, then would start to move more convincingly back towards stage 2. But at the moment, you can see this moving average breadth has just been coming off since February and has been gradually getting lower. So, as I said, back down at 39% at the moment. So obviously not tracking what the indexes are doing at the moment. So it does look a little bit vulnerable to a sharp, obviously, break. Whether that then recovers, whether we get a sharp break and then rebound move back up again, and then obviously that's a possibility. But it does have a look of a rising wedge to it currently. Not trying to influence you there. I don't know. People obviously can take what I say very, very literally. So just trying to present the data. So at the moment, obviously showing a gradual grind up, but obviously could be stronger there. If we look at the percentage of stocks above their 200-day, 50, 150 and 50-day moving averages in a separated manner in the S&P 500, so not the entire US market, but just the S&P 500. This is a 20-plus year chart here. See 21 years just. And see the red lines across here show the current level compared to historical levels. So we did come out of obviously the lower zone. We did have a buy signal through these as it came back out back in the latter part of 2022 there, and we're still holding up in the more middle range, but it has come off significantly over the last few months, and it is drifting back down towards the lower end of the neutral range at the moment here. We zoom in on this a little bit, you can see more recently in the 200-day, the 150-day and the 50-day here have all been rolling over here, haven't been showing much strength, while the indexes obviously have been doing the opposite, obviously grinding higher in the NASDAQ and composite, NASDAQ and NASDAQ 100, the S&P 500 obviously testing the highs there. So again, the moving average breadth, not a bit of an anomaly compared to what's going on in the indexes, but obviously only price pays, as Brian Shannon likes to say, and obviously then the indexes are moving higher, so just gotta go with the flow. But obviously this does add a note of caution to any moves higher. We look at the NASDAQ 100. This is our leading index year to date. So you can see it literally turned first week of the year and has been grinding higher ever since. Broke out into stage 2 a little while back now. Now getting up to, this is a SATA score of 10 this week for the first time in the NASDAQ 100 here. So that's our stage analysis technical attributes. So obviously its characteristics are now at their maximum potential scoring as a daily and a weekly score of 10 on the NASDAQ 100 futures there. So generally, when we get to a maximum score period, it can be getting to an extended point. It can still run for a few weeks or so, but generally it does mean it's getting extended, as obviously it's getting too perfect. We generally, during a stage 2 run between a 7 and a 10 for the majority of a stage 2 advance. So generally you want to see it'll chop back and forth between that, but when it gets to the extremes, you start to get a contrarian view on that and be looking for obviously some kind of consolidation or pullback move. So at the moment, a little bit extended here, but obviously incredibly strong compared to the other markets. And you can see obviously outperforming the S&P 500 significantly here. Looking on a daily chart, you can see obviously getting up there. I had the free ATR candles on this, did it on the bigger version of the chart. You see it's pushed out of the free ATR level at the moment. Last time it did that was back at the February peak there, before we had a little pullback to the 200-day moving average. So getting extended from its normal daily range at the moment, just above the free ATR level. So with those, obviously the semiconductors pushing high, you can see obviously got that look with the Nvidia look to that, where it pushed up on Thursday and then followed through on Friday. One thing I wanted to note about the NASDAQ here is that the NASDAQ 100 particularly, this is the QQQ ETF year to date, not year to date, end of year performance since the year 2000. So you can see of these percentages, we've got a few years where it massively outperformed and after bear market years. So obviously after the 2002 bear ended, it had a minus 37%. We then had a 49.67, we had a minus 41 in 2008, and then we had a 54.7 in 2009. But mind, 2009, it did obviously have a significant pullback and low into March and then rallied again. So this, at the moment, this last year we had a minus 32% year. So this year currently we're at 31%. So if we go from here, 32%. So we're roughly at this level at the moment compared to all of these other years. So the question I asked on Twitter yesterday is that basically, yes, whether it's a bull market or not at the moment, because obviously some of the other markets are not particularly moving with the NASDAQ 100. It's certainly a bull market in the NASDAQ 100, but is it the risk reward good at this point, as we're at obviously currently at 31%? You can see we're at the upper end of the normal distribution in terms of our average distribution. Obviously they're in the more extreme years here, the 54.7 and 49.67 from 2003 and 2009, then you've still got a ways to go here. There's still potential. I think from the current level here, it was another 18% to year end potentially, but obviously markets do not go in a straight line. So if you've got a pullback, then there's potentially still good room year to date. But from a risk reward point of view at this point, with the market, the NASDAQ running as it has been, obviously a SATA score of 10 above its free ATR level, and obviously getting to the end of the normal distribution. Basically, the question we're asking is the risk reward good at this point for new entrants? For example, if you were coming from a cash position now into the NASDAQ 100, and obviously looking at this, you would say no at the moment. You would be looking for some kind of consolidation or some kind of pullback potentially to give a better risk reward at the moment. But doesn't mean that it can't obviously have an extreme year like we saw in 2009 or 2003, as we have just come out of one of the major bear years. But there's obviously no guarantee that this year is going to end obviously where we're at currently or higher. It could obviously pull back just as easily. So just wanted to make that note, as I think it's an interesting way to look at it. NASDAQ Composite, 2 weeks into stage 2 now, so not confirmed stage 2 as yet. I always like to keep the attempt word on for the first little bit, because obviously you could still get a rollover, could start to come back in and fail. We often get that happen. So obviously normally I like to wait for the first pivot to form and then to make a higher high until I remove the word attempt, and it's just then the stage 2 breakout. But at the moment this is pushing up into its old resistance zone here, so where it pivoted back in August last year and the pivot from back in January. Obviously moved around through that level a bunch of times. So this 13,000 level that it's just bumping into at the moment is obviously a significant area. So definitely coming into an area of resistance. And again, we look at the percentage of stocks above their 200-day moving average in the NASDAQ here. So obviously not tracking with what the price action is doing again. So again, a little bit of an anomaly there and a little bit of a potential red flag to keep note of. But obviously the price action is the most important thing, and at the moment it has been moving, but we are moving into an area of resistance. So, and obviously a little bit short-term extended again. If I add the free ATR levels to this, we've hitting that free ATR level, which again hadn't been hit since that February peak. So same as what we saw in the NASDAQ 100, but obviously had a good run. But once it is starting to look good, it's obviously not always the best time to be considering it. It's normally much better to be considering it when it doesn't look good. So at this point, we're now short-term extended. That rubber band has got stretched a little bit far here. So potential for a little bit of consolidation would be healthy here if it can consolidate in that resistance zone around the 13,000 level. Next up, Russell 2000 still consolidating below its 200-day moving average and the 30-week moving average here. So on the weekly chart here, you can see this significant bar from the crisis in the banks remains obviously the looming resistance in the near term here. Hasn't managed to recapture even half of that bar. Obviously, the whole bulk of the price action has formed in this lower range below it and below the 30-week moving average here. So we haven't had a close back above the 30-week moving average since then. So multiple months now below that. So just consolidating above the 10-week moving average at the moment, but still within this broader developing stage 1 range and obviously underperforming the S&P 500. We're looking at it from a daily basis. Again, this has got the 200-day moving average on it. So that's that obviously bar I was just highlighting there from the weekly chart. So again, here's the 200-day moving average area around this 180 level. You see we haven't had any closes back above that. It's tested it multiple times here, but hasn't managed to close back above the 200-day moving average. So at the moment, still in a weak position compared to other indexes, which obviously are surging into stage 2 or testing the stage 2 level. This is still sitting deep in its stage 1 range and could obviously possibly break to the downside and make a stage 4 continuation even. So, but currently still in a neutral position, so could go either way at this point, but certainly the weakest of all of the indexes. VIX has drifted up a little bit since that was the early May low there. See it peaked. We started to drift a little bit higher here. So potentially, if it did have a one negative day, you can see the 200-day moving average has been drifting lower as this has been drifting higher. So we're getting to a point where this sudden sharp reversal, we could actually turn back to the negative very quickly there. It could get back above its 200-day moving average. At the moment, it's in a positive to neutral position, so slightly positive at the moment where it's at. So, but it could obviously be a lot more positive. It can start to break lower here and get further away from that 200-day moving average. But if it does start to move back above this 200-day moving average, then obviously that would be much more negative and significantly turn it to risk off again very quickly as you start to break some near-term pivot highs if we start to get back through there again.